Today I'm talking about employee share schemes, and you may have heard of this out there in the wild. You may be approached one day from your employer to take part in the employee share schemes, and this is an actual case study of a real life person who I know. It's been de-identified, and by the end of this recording, you'll be able to really have a solid grasp on what an employee share scheme is. Now, I'll first start by saying this case study isn't an RSU. You may have heard those words, restricted stock units, and I will do another case study on employee share schemes, RSUs. They're the type that you might get if you work for a big corporate. I'm thinking your Apples, your Microsofts, your Teslas, like huge corporate companies. But this employee share scheme is one that's quite common out there with professional practices like architect firms, engineering firms, legal firms and partnerships, that type of thing, where a lot of it is business value. There's less about producing product and more about consulting and doing fee-based type of work. So that's what we're going to have a look at. If you are listening on the podcast, this is on YouTube. I'll put a link in the podcast show notes because you might want to go back and have a look at the YouTube video. If you are watching here on YouTube, thanks for being here. Let's get into it right after this. Before we get into it, this show is general advice only, and I've got a license to provide that advice. Full details can be found in the show notes. I'm a former financial advisor. Now I do the Money, Money, Money podcast. If you're a regular here, we call it M3, and we do a podcast called Retire Right. I've got a book, The Quick Start Guide to Investing, is available wherever good books are sold. There's a link in the show notes if you want to turn up your investing to 11 or if you're just getting started. Let's get into it. Thank you so much for being here today. Okay, so as you're watching this, if you are working for a big company like Microsoft or Apple or any other large listed company, there could be still some considerations that I'd need you to understand when you're thinking about, well, should I participate in these share purchase plans, these employee share schemes, the stock options, because just because we can do something, it doesn't mean that we should. Now, we're going to get straight into the presentation here. Melissa, she's aged 38, has a spouse and 3 kids under 14. They're renting near a city. They moved from the UK about 5 years ago. She's been a qualified architect for 10 years and been at the current company for 4 years and doesn't mind it. The salary is market rates, and in terms of her education skills and what the market is paying for her role as we'll just call it a senior architect, it's actually nothing special in that world. And that's an important thing to note as part of this case study. But we'll just assume $120,000 because she could go and get more money at another place. And this is when it comes to our careers, we really need to have a look at, well, what we're earning at our current work and the environment and the opportunities and potentially the flexibility. And is it worth actually leaving here to go somewhere else where it might not be as favourable conditions, even though there is more money? So let's keep going. So the company, they've been established for 35 years. They're architecture, internal design, and they do commercial fit-out consulting. At the moment, there are 3 directors aged 65, 55 and 42, and we'll just assume that they are the majority shareholders. There's 40 employees. We don't know the value. We don't know the annual turnover, but we do know that there is a bit of a higher turnover after a few years once people might train there and they're a new grad and they effectively leave. Because remember, Melissa here could go to another firm and get a higher rate. So we know that they they quote unquote don't pay more than kind of the minimum for the staff. Now, these are some assumptions that I've made. I'm calling it the Magic Designs Australia Pty Ltd. I've just made some assumptions and they don't really matter for the case study here, but 18 to 20 million turnover. The profit could be about 1.4 million. The dividend pool could be around $1 million. And the profit margin could be, 6 to 8%. And the value of this business, it could be anywhere from $4 to $8 million. And just at the outset, when we are looking at companies like this, which are maybe your legal firms, your engineering firms, your architectural firms, potentially accounting firms, these professional service-based partnerships firms, there isn't, quote unquote, the value in the company why you'd be buying in for that, because they don't produce any products. There's generally not an ongoing service. Like if you compare it to the big companies like Microsoft, Apple, Google, these are big companies that have different products, and it's just a different mindset when we look at these employee share schemes, rather than just a play for the capital growth if we are invited to participate. A lot of these firms generally don't have an earn-in or a sweat equity where they'll give you an allocation to equity, and maybe you might do, overtime and, buy in that way in lieu. So what we're about to go through is pretty standard kind of vanilla terms that you may see out there in the wild. And just remember the underlying stuff that we're going to talk about here, some of it will be relevant if you are an employee of a big company that has the restricted stock units. But let's have a look at some of the mechanics behind the offer that was given to Melissa. So first and foremost, people are invited by the directors to participate. They will set a share price, and in this instance, we'll just assume $40 per share. They must buy a minimum of shares. Now, the minimum in this offer for Melissa was 500 shares or $20,000. So at the very start, if Melissa doesn't have 20K, it could be a easy answer. However, there is finance available through the company's business bank. The dividends will start in July 2026. We're recording this at the start of the year. So they do give you, I won't go into details of the timing, but generally what happens is they will they'll invite someone to participate. And it could be someone who has been around the company for a while, like Melissa. She's a good worker. She's been there 4 years. They see some potential in her to, want to invite her into the the employee share scheme. And then basically the timeline would be, hey, Melissa, do you want in? She would then maybe have a couple of months to decide. And then on that kind of application form, she would give them an indication of how much she wants to purchase, and whether she would like the financing from the company's business bank to do so. And it's pretty straightforward there. But the one thing we need to look at here is and usually in companies like this, they may only do this every few years. So if Melissa says no today, she might have to wait a year or more to get an offer put in front of her again. And then so if there was, 3 employees that they invited, and, one said 50K, one said 100K, and another said 50, we know there that the directors have 200K. And what they can do is because effectively we've got to sell some shares to these new employees, they might not want to sell 200K worth of shares. So the directors will allocate and decide the allocation once expressions of interest have been received. Now, why do companies offer share purchase plans? And my default, position is I'm not that interested because there could be bigger strings attached than the upside. That's my default response. But, going through this exercise, it could be a good fit for somebody like Melissa. But generally speaking, why do companies want to offer employee share plans? The first one is retention. So they know Melissa's good. They want to lock her in for the long term because they can see that she's valuable to the company. It also keeps the cash flow leaner for the P&L. So again, we go back to where Melissa isn't paid, overs in terms of crazy above market rates. It keeps kind of the company P&L pretty lean month on month. A big one here is the succession planning. You'll remember one of the directors, I think it was 65 and one's 55. This director, who potentially was the founder, as part of the succession planning of the business, is to slowly offload company shares to other employees and other associates and get some money off the table along the way. They can reward some loyalty without giving up control, and you'll see the type of control that Melissa will, or rather will not get, if she decides to go down this road. It's a potential way to raise some funding without getting external capital. And what do I mean by that? So, for example, if the company needed $500,000, there could be a way that the founding director or a couple of the directors sell some of their shares to other staff members, and then they might set up loan agreements and loan that money back to the company at favourable rates and without strings attached like banks and lenders will do. We know that one of the reasons companies issue bonds or corporate bonds is because if I'm a company and I wanted to raise $1 million, or big listed companies might be, we want to raise $500 million, it's better for us to borrow the money from people or bondholders of the company, pay them an interest rate, rather than potentially going direct to a bank getting a lower rate, because a bank will traditionally want to review the financials every 3 months and make sure everything's going smooth. So it is a way that potentially we can get some cash back into the company without external capital from banks and whatnot. Or it could be a combination of it all. And that's really what I wanted to stress here in terms of this type of case study is, a very, very normal way that these consulting type firms do succession planning and build for the future. Now, in the offer document that was sent to Melissa, and some of these numbers were really crazy, and it's almost too good to believe, but there is a solid track record of the company actually being in profit and giving dividends. And I think they pay the dividends monthly, which is important to note, but some other companies may pay dividends quarterly, annually, every 6 months, whatever that is. But the last 3 years running, based on 500 shares, the dividend was $24 or 60% return. In 2024, it was $22 per share or a 55% return. And 2023 was $15 or a 37% return. Now, we know with, these are really good returns. And even if we use, say, 9 to 10% as a kind of benchmark for a really good year with Aussie equities, when we're looking at anything, 37.5% return, that's fantastic. 60% return, it's crazy. Like, this is really solid returns. But I would encourage anyone, if they're given numbers like this, to make your assumptions based on maybe even 10%, maybe even 20%. There could be years where there is no profit. And that's kind of one of these, this is the tension between, do we put money into this thing or not? Because in one hand, it flies in the face of diversification with our investing, right? We're putting money into a single company and it's not liquid, there's no visibility and all that. So That's what the history says. Now, if Melissa did do $20,000 of her money and put it in, if it did return 30%, it would take 3 years and 4 months to recoup her capital. Now, pretty easy maths. If it was a 50% return, it would take 2 years. So it's not kind of rocket surgery to work out potential capital payback timeframes, but I would just stress to make really conservative assumptions. Now, what if Melissa and her family, her spouse, they turned around and said, look, we want to inquire because, we don't have this $20,000, but we want to see if we can borrow some money. Now, traditionally speaking and during the ordinary course of business, the company would have its bank with a business bank, and the relationship there could be so they will lend to employees for these schemes, but there's a couple of things to note with the finance terms. Usually, and every situation could vary, it's going to be a 5-year term maximum. It will be principal and interest, and the rate's going to be likely fixed. So the interest is baked into the whole term. And secondly, it could be a bit higher than, your traditional home loan lending rates, because we know that high risk means higher return. So for the lender, there is a high risk. So it could be at the moment, end of 25, start of 26, could be an 8% type interest. So let's have a look here. If there was a 5-year term at 8% fixed interest, 8% fixed principal and interest, we've got to come up with $25,000 a year just to, get this thing off the ground. So over the 5-year period, there will be $25,250 in interest paid, which of course is deductible because this is effectively an investment. But we know that if someone did borrow $100,000, usually, it should wipe its face, assuming that 30% return, because each year we only need a 30% dividend to cover our costs. There will be potentially some timing issues, and it's probably not going to be as savage this one because they are paying dividends monthly. But we know that depending on the arrangement, you'll need the cash flow to cover the costs until the dividends keep coming. I want to have a look now at share classes, and I'll do that right after this break.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au, and they'll point you in the right direction.
Okay, I'm back. Traditionally, there are going to be share classes in the offer document that is given, and the share classes that were in the document offered to Melissa were associate director, associate shareholder, and employee. Now, let's just have a look here, and if you are listening, there is a diagram just with some examples of the different shareholders in the company. So if the company is here, I've carved out the director and founder who is 65 and the director who is 55, because I'm assuming that they are the directors who are basically controlling the company at the moment. And you'll start to see here, the associate director is age 42 years old. That's a different class, and we'll go into what each share class, what entitlements they get. Then there could be some associate shareholders. So, for example, the associate shareholders, there's two in this example, they could be department managers. So we've got 3 directors, 1 associate director, 2 are directors and founders. The associate director have got their own class, the associate shareholder, their own class, there's 2 of them. And then the employee shareholder, I've just assumed that there is 3 current employee shareholders, and even, if Melissa takes it on, there could be 4, or we don't know if they've offered it to other people as well. But generally, you've got to look at this stuff like a bit of a conveyor belt. So we've got the 65 and 55-year-old. Over time, they will drop off, but the company needs to replace managers and directors and associates over time. And this is part of the mechanisms to lock those people in for the benefit of the company. But if we have a look here, generally speaking, if you're offered to be part of the employee share scheme, you would show signs that you're half decent, they want you involved, and to enjoy some of the upside. Now, let's have a look at the share class of employee that will be entitled, that Melissa will be entitled to. And this is where it really gets to potentially be a bit like, this is too much risk to worry about. Number 1, you don't know what the company value is or any rules or methods that they've used to value the company. You've got no idea of the number of shareholders. So the page before, I'm like, well, we'll assume other associate directors, some associate shareholders, some employee shareholders. The only way you would know is if socially you know that your manager is in the scheme. But we don't know if there is other external parties involved because it's a private company, basically. You've got no idea or visibility of any of the company financials other than what they share with the team. You've got no idea of the company health, like is this thing, going down? And you've got no voting rights. So if we need to vote to remove somebody, the director, you're a passenger basically. You've got no director appointment rights. You only receive percentage-based reports. So it could be, profit was X percent and there's your share. And there's no insight or visibility to dividend formulas, nor do you have access to internal reports or strategy papers that the 2 or 3 main directors would have. So you are effectively a passenger. And just for completeness, we'll have a look at the other 2 classes. If you go up and you're an associate shareholder, so you might be one of the managers, there's a chance that you could participate in management discussions, but you really don't have a binding say. And you may get greater informal involvement in the business, but you've still got no rights to anything really. And then the associate shareholder, the associate director, like the next class, you basically get full access to the company financials. You get access to the total shares on issue and the structure. You'll get access to the valuation policy. You'll get access to internal reports. You'll get some meaningful influence, but you still don't get automatic right to appoint a director. But it's basically the first level that you can actually have some type of control and seat at the table. So three main classes in this example. The employee, which is the lowest. Then we've got associate shareholder, then associate director. So let's move along. Now, there are some what we call exit rules and drag along provisions. So I wanted to spend a bit of time on this good leaver and bad leaver. So a leaver is someone who exits the policy, the company rather. Now, if you're a good leaver, you have resigned and left on good terms, right? So it's all good, it's amicable, no issue. You may have retired. You may have part of the good leaver as well if you died or became disabled. A good leaver is what you want to be in this situation. Now, a bad leaver is someone who may do something dumb and get fired, may do something, anything that would cause you to potentially lose your position of employment if you do something dumb at work, maybe some professional misconduct, anything that's quote-unquote bad leaver. And the reason these are distinguished in the shareholder documents is, and depending on the company, I've seen a few, the bad leaver, it might say, well, you sell your shares at 20% less. So it will cost you because you left under bad terms, so we're not paying you the full market value. It could be at the discretion of the directors. So this is where it gets murky, and you've got to look at your own individual document. Now, as a general rule of thumb, you can't keep holding your shares even if you left as a good leaver. You can't say, oh, I'm out of here, see you later. There would be a clause in there that you actually have to offload your shares. Now, I talked about being a passenger for, the financials and whatnot. You're also a passenger if the directors and, the founders, they decide to sell the whole company. That's called drag along or drag along provisions. You're physically just dragged along. You could get a knock on the door, hey, we've sold the company, spit out, here's what you're going to get. Now, the exit rules, so we're talking good leaver, bad leaver, it's likely to, and you've got to check the contract of the document that you're given, or the details of the document that you're given. It's likely there could be some different exit rules for each. So the employee will obviously be the most harsh. The director's bad leaver as an associate director could just say 10% discount or whatnot. So that's what I want to get home. There could be different exit rules for different classes. Okay, ownership structure. Now, I'm just going to draw this for those who are watching on YouTube. And if you're not, you can still get an understanding. So if this is the proprietary limited company, if you wanted to, and I'll just draw a stick man, you could effectively put in the document that you want to buy 20K or 100K worth of shares in the offer document, and you could own them. So any dividends that are received, the money would fall straight into your lap, onto your tax return. It would likely be franked, so there would be some franking credits in there because the company has likely paid a fully franked dividend. So you get those tax credits, but it's all lopped on you. Now, there is provision in the documents, and you'd likely put in your expression of interest that, yes, I would like to buy $20,000 or $100,000 worth of shares, but the entity to be advised. If you were going to do a significant amount, I think there is a strong argument, particularly, and we'll get into this a bit more of why should or shouldn't Melissa do this. You might set up a family trust, and it might have a trustee company and a family trust that would own the shares. The family trust would get the loan from the bank, and the family trust would pay the interest back to the bank. The family trust would then have to do its own tax return and financials. But the benefit there is you as the employee won't own the shares directly, and the family trust would be that would have you as the beneficiary, but you could also potentially use your spouse or partner, depending on what their employment situation is, or children, depending on their ages and anything like that. So when you receive the dividends, you can distribute that dividend income to other members of the trust. You might put 100% of the dividend to your spouse or partner because they're not working. Now, you need to get specific advice about this from a lawyer and accountant, but generally speaking, in this situation, there's a thing called personal service income, and that wouldn't potentially be an issue because it's not as if Melissa is a consultant and she's got a company and everything rests on her. Like, it could be seen as an actual investment into a company. Now, if you are setting up a family trust, a couple of things. If you are borrowing from the bank, later on, the loan that's in the family trust, it won't impact Melissa and her partner's personal mortgage because it's a different entity, so it likely won't fall as an existing debt on Melissa's personal application for a mortgage. You will have to do accounting and tax returns for the family trust. You'll likely potentially set up another bank account. Could be $4,000 or $5,000 to set up the family trust. Could be $1,000 or so a year to do all these. So that's just a way that you can do it. I would caution holding shares directly in your name if you are wanting to be at this company for longer term, because there will be other times where you'll potentially get the offer to buy more. So that's kind of, in terms of ownership structure. There could be some ways that if you don't do the trust, and this is going to all be at the discretion of the company and the directors and whatnot, to put the shares in a spouse's name and they're linked to you because it would be no different than if it was a different entity. But it's just one thing. Just get some advice if you are considering. Okay, so let's have a look at the risks to Melissa for doing this. Well, we've talked about there's no visibility or control at all. Literally a passenger in every sense of the meaning in the word. No liquidity. So we know when we buy shares, we can sell them tomorrow. We know if we buy a house as an investment property, sure, it's not liquid because, you know, we can't just walk in and cut off half the house and get some money out, but we can put it up for sale. So we do have some control there in order to, we want to sell the house. So there's virtually no liquidity in this. I've put opportunity cost here for a couple of reasons. There are potential opportunity costs if they didn't want to borrow the money and wanted to buy a house or do some other type of investing in their own name. Putting the money into this company could be an opportunity cost in other areas of Melissa's life. There is a risk that there's the business turndown. We know that this is a mature company. We know that this has been around for 35 years. They've obviously got some long-term contracts. They've got a solid name, but there is still a risk there that's potentially out of Melissa's control. There is a risk, and this is where my default vibe goes to, you know, there could be some golden handcuffs there if the working conditions change. So what do I mean by that? If you haven't heard the term, you're basically tied to this company financially, and that's why they call them golden handcuffs. Lack of diversification. So there's potentially a big concentration risk of putting money in. But I really think if the dividends and the distributions each year have been quite strong, the risk lessens over time because this is more about a cash flow thing than a capital growth thing. So this is about year-on-year money into your life. Now, why would Melissa do this? Well, she may be thinking, well, I'm going to be there for the long term anyway. I don't hate it. So, hey, I may as well take part of this. There could be an opportunity to increase the household income by doing this. But I guess the thing is we've got to remember this place, they don't pay the workers more than a real minimal market rate. And I think that's the kicker here. If you are going to lean in and be in this company long term, it's a no-brainer that you need to do this if you want to maximize the revenue as a trade-off to trying to get an extra 30 or 40 grand a year from somewhere else, okay? One of the good things is if it is a long-term play, you've actually got a future seat at the table for succession planning. The 65-year-old's going to be exited one day and the conveyor belt's going to move along. If there are more shares on offer, they may just go to the existing owners first rather than inviting new employees. So there is always a seat at the table. And it does tell management that Melissa is serious and committed because literally got skin in the game and is a part of the scheme. So let's now have a look at why wouldn't she do this? So we've looked at the risks. We've looked at why would Melissa do it? And then let's have a look at why wouldn't she do it? And this could be kind of parallel to the risks, but it could be a toxic culture cesspool. She just dislikes the people she works with, other directors and managers. She might just not want to put the capital in. She might not want or can't get a loan. And if you did get a loan through the business bank, there'd probably be a personal guarantee on it, even if you did it through a company or trust. Melissa could choose that she would rather get a higher income in the marketplace with no strings attached than staying where she's on a lower income and having to, do all this stuff. And she might just want to focus all her energy on buying a house at the moment, i.e. it's not the right time. So it could be, well, no, I don't need the distraction. I'm still not 100% solved. She could say to them, look, I'm not going to do it this round. It's not the right time, but next round, please let me know. And that's kind of why she would not do it. And these are really, I think these situations, and we talk about it in the money world with different types of investment products, and I kind of say the word the pendulum. These type of schemes, I really think the pendulum swings the most either way. So this is going to be really, really good for somebody and it swings like in the real good section, or it just swings totally the other way. Like this is just not good. And let's have a look at the summary and I'll finish with some of my broader comments. If the money is borrowed, needs to service the holding costs. And I'm probably taking the risk and borrowing the money, if I'm being honest. We've got to see this as a cash cow. It's a mature business. This isn't a play that Melissa's $20,000 share or $100,000 share in 3 years is going to be worth $50 million. Like it's not a growth play. It's a cash cow play. And if she loves working there, it's good flexibility, and she's in it for the long term, it could really make sense. And if she wants to earn, quote unquote, really good, exceptional money from her role, she'll actually need to do this, or she'll end up leaving anyway. So what would I do in Melissa's situation? Well, if we go back to the start, and I just have a look at Melissa's current situation. So Melissa is 38 and has a spouse and kids, 3 kids under 14. They're renting at the moment. this is a big flashpoint for Melissa where I think she does need to make a decision. Do we do this and lean in? I would probably say to Melissa, apply it for $200,000 or $300,000 and see if they'll issue it, because it's not binding until you sign. So I would run the flag up the pole and be like, well, if you can give me 100 or 200 grand from the business bank, and if it's a decent interest rate at 8%, we know that there's a track record, I think we can get this kind of locked away and the capital repaid within 5 years, claim the interest along the way. It could be a good little thing for Melissa, but I guess the risk is over time the risk will reduce, but realistically, until the money or the capital is paid itself off, until you've got kind of the house money in there, and then when you're in 100%, I'll say profit, as in lending has been paid back in full, I think Melissa needs to take this chance and potentially do something for her family and her future and see what happens. It kind of, again, this is the pendulum thing. On one swing of the pendulum is quite low risk. Well-established company, it had a strong track record of paying really good dividends. 60, 50% dividends, if they fell to 30 or 25, it's still really good in terms of percentage return. So at one hand, it's kind of low risk, but the other hand, it's high risk because it's just one company, eggs in one basket. But I think when you're in these professional services type businesses, it's fully a cash cow play, like law firm partnerships, accounting, engineering, architecture stuff. So I think the more I think about it, even in this situation, is Melissa does it, gets lending, does it through another entity, like the family trust, and maybe tries 100K, 200K and see how much they'll issue and do the numbers based on, what is kind of allocated to her, because they'll come back with an allocation that still won't be binding until you sign. So we run the flag up the pole, go, yeah, we want 250. They come back, okay, we'll give you 120. Speak to the bank. Yep, the bank will give you 120. There'll be a personal guarantee. Sweet. We'll set up a trust. They may lend on the setup costs, unlikely, but you're going to have to cash flow that. But the good thing is, once the dividends start in 6 months, it'll be monthly cash flow play. So it's probably just the first 6 months or so, potentially, where you've got money lined up, you're invested. And this is where every scheme will be different, but I'll try and do one of these little case studies on the restricted stock units in the very near future. If you found this beneficial, please send it to a friend, a family member. Or if you're in a business that offers these type of schemes, it could be a good video to show people just the high-level mechanics of employee share schemes. My name's Glen James. Thank you so much for watching and listening today.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the product disclosure statement, PDS, and target market determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.